Capital structure. Are you familiar with how businesses fund their operations and growth? This video explores the intricate world of capital structure, explaining its components and importance. Dive into how the mix of equity, debt, and retained earnings can shape a company's financial future. Capital structure is the blend of equity, debt, and retained earnings used by a business. It supports long-term operations and assets, varying with business type and strategy. Equity includes share capital and retained earnings. Debt involves loans and bonds. The balance impacts financial health and risk. Equity capital involves money from shareholders, offering ownership and dividends. Debt capital is borrowed funds like loans and bonds, requiring repayment with interest. Retained earnings are profits reinvested into the business. Each component has its pros and cons, affecting control and financial risk. The cost of capital varies with each source, impacting financial decisions. High debt increases risk but can be cheaper due to tax benefits. Equity may reduce risk but dilutes control. A balanced structure offers flexibility in raising funds. Different approaches match business goals and risk appetite. Different businesses adopt varied capital structures. Sole traders use personal funds and small loans. Partnerships rely on partner contributions. Private limited companies mix shares and loans. Public limited companies use equity and bonds. Each structure aligns with specific business needs and strategies. The choice of capital structure is influenced by securities, gearing, and business size. Shares and debentures offer different control and risk levels. High gearing indicates more debt, increasing financial risk. Business size and profitability also play roles. Market conditions affect the cost of financing. Businesses raise capital through shares and debentures. Ordinary shares provide ownership and voting rights. Preference shares offer fixed dividends. Debentures involve fixed interest payments. The choice impacts control and financial obligations. Each option suits different business strategies and risk levels. Gearing measures the debt-to-equity ratio in a business. High gearing means more debt, increasing potential returns and risk. Low gearing indicates more equity, reducing risk but raising capital costs. Gearing affects creditworthiness and financial stability. It's crucial for strategic financial planning. Business size, profitability, and income stability influence capital structure. Factors affecting capital structure include business size and profitability. Startups rely on equity due to limited credit. Profitable firms use retained earnings. Stable income supports higher debt levels. Control considerations affect equity issuance. Market conditions dictate the attractiveness of debt. Capital structure shapes a business's financial stability and growth potential. The right mix of debt, equity, and retained earnings is essential. It depends on business goals and market conditions. A well-planned structure reduces costs and supports success. Each business must tailor its approach to its needs. Undercapitalization occurs when a business lacks sufficient capital despite high profits. It leads to overworked assets and delayed payments. Causes include starting with too little equity or debt. Over-reliance on short-term borrowings is risky. The focus is on maintaining high returns rather than growth. Overcapitalization happens when a business raises more capital than needed. Profits are low, affecting dividend payments and share value. Causes include buying assets at high prices and poor investment decisions. It leads to idle capital and reduced profitability. Restructuring may be necessary to restore balance. Undercapitalization and overcapitalization affect financial strategies. Undercapitalized firms focus on high returns, risking long-term growth. Overcapitalized businesses face cost-cutting and restructuring. Both impact shareholder confidence and business efficiency. A balanced capital structure is crucial for stability. Undercapitalization offers high dividends, but risks future growth. Overcapitalization leads to low returns and falling share prices. Shareholders may push for changes in leadership or strategy. Businesses face operational constraints and reputation risks. Balancing capitalization is key to maintaining investor trust. Undercapitalization may lead to market dominance and price inflation. Overcapitalization results in job insecurity and reduced community investment. Both attract regulatory scrutiny and affect local economies. Public perception can impact business reputation. Addressing capitalization issues is vital for social responsibility. Businesses must adjust their capital structure to address undercapitalization or overcapitalization. Raising additional capital or restructuring can help. Reducing debt or buying back shares may restore balance. Effective management ensures financial health and growth. Strategic planning aligns capital needs with business goals. A balanced capital structure supports long-term financial planning. It aligns with business objectives and market conditions. Flexibility in raising funds is crucial. Businesses must monitor their capital needs regularly. Effective planning enhances stability and growth potential. Capital structure is a critical aspect of financial management. A well-balanced mix of debt, equity, and retained earnings supports business stability and growth. Understanding and managing capitalization issues is vital. Strategic planning ensures long-term success. Businesses must tailor their approach to their unique needs.